Good evening, everybody. Welcome to Tideway's webinar on the budget, the autumn budget 2025. I'm James Baxter, as you probably know, and I'm joined. Well, no, before I do that, I'm going to do some compliance. I should give you a compliance warning, so you've had it. No, basically, anything we say now, really don't construe it as personal advice. If you've got questions or you're thinking about this stuff yourself, come and talk to us and we'll give you individual advice rather than taking as read what we talk about today. Okay, so I'm joined today by our young stars of the business. I have here uh, Mihir Choughule, who has been with us for just over 3.5 years now. And on the other side, Harry Donoghue, who's been with us just 3 months. Both Harry and Mihir are chartered advisors. Right, we're going to look at the budget, obviously, and we thought we'd attack it in three sections. So we're going to look at the changes that have been introduced in the budget. We're going to look at what hasn't changed and the opportunities that we've got for planning to try and help alleviate some of the worst of the budget. And then we looked at all the questions that came in ahead of this webinar, and we've tried to answer as many as possible in these first two sections, but there were a couple that didn't kind of fit in with our agenda, so we'll pick them up at the end. Plus, as ever, we've got a couple of polls to test you on, just to see where all your heads are on these things. And I would say, please ask us questions as you go along, and we will try and answer them as live as we can as we go through the session. So, straight into it. Mihir, you're going to talk to us about the tax thresholds.
Perfect. Thanks, James, and hello, everyone. So I'll go straight into it. The tax thresholds were frozen up until 2031, so that's an extra 3 years from what had already been announced at the last budget. So, for example, the higher rate tax threshold, which was fixed at £50,000 approximately in 2016, will remain at that level for until 2031. If it had kept pace with inflation, that should have been worth about £70,000 in
Today already.
today already. And just to show you the effects of inflation over the almost decade since it was introduced in 2016, that £50,000 in today's terms is equivalent to £36,000 in 2016. So that just shows you the effects of inflation over the long term. Now, I want to give you an example of a case study of how this would impact pretty much a regular person, or at least in London, but you yourself, your children, or your grandchildren, you may know someone in this situation. So consider an earner of £100,000 in the UK. He or she has student and postgraduate loan, and they also have two young children aged, let's say, 2 and 4 years old. Now, the moment he or she goes above £100,000 in terms of their gross salary, the effective marginal tax rate is over 100%. So not only do they not see any benefit from going,
Hang on a minute, Mihir. You're basically saying to pay them £10,000, they're going to be worse off.
they're going to be worse off because not only do you pay the various, income tax, your personal allowance gets reduced, national insurance, but your childcare also gets taken away from you, which can be up to £4,000 if you have two children. So £2,000 per
Yeah.
child. So effectively, even though your gross income is going up, your net income is actually reducing
So we've got people paying 100% tax
over
effectively,
100%.
over 100%. And we didn't include the employer's national insurance in that
Yeah.
calculation, which is pretty horrendous as well. So we were reflecting on exile in Main Street when the Rolling Stones left in 1972. And they got to 90% tax and all buggered off, left the country. And here we are in 2025 charging people over 90% tax. And only earning 100,000. I'm sure Mick and the crew were earning a lot more than 100,000 in those days. Anyway, that needs to be fixed, I would suggest. And it's a real disappointment on my behalf that the government couldn't grasp the nettle and sort that out, because it's a really insidious amount of tax to be charging. Anyway, what else would you like to say about the thresholds, or is that it, Mihir?
I think that's pretty much it. I think, it should give you an understanding of
Yeah.
how, people are,
So
allocating
they
it.
haven't increased the rates of tax,
No.
but they are increasing the amount of tax we're paying, not by increasing the rates, but just by leaving these thresholds and slowly pushing more and more people. We had some figures about how many more million people will be higher rate taxpayers,
Mm.
and by 2030, at the rate we're going, an average income in the UK is going to be a higher rate taxpayer almost.
Mm.
So we're all going to be paying 40% on some of our income, which is pretty horrendous. Right. I then thought I would cover things going on with companies, and in particular, dividends, corporation tax, and national insurance. Now, corporation tax wasn't changed in this budget, but it did get changed a couple of budgets ago. So, to remind people, in companies, you pay 25% corporation tax. And then companies have now got this Hobson's choice as to how we pay that money out, either to ourselves or our employees. So you can pay yourself PAYE, in which case you pay 15% national insurance now. That rate was increased substantially last budget and hasn't been changed. And then you have to pay these PAYE rates, which are obviously being caught by the thresholds. Or you can come out by dividends if you own the business. And something very dear to my heart. So the basic rate tax on dividends has gone up a whopping 23%. It's gone from 8.75 to 10.75. On a higher rate income, you will go up from 33.75 to 35.75. Mercifully, they've left the additional rate of tax. 39.35 is still 39.35. But basically, if you're trying to take money out of the company, by the time you've paid your corporation tax and your dividend tax, you're actually paying now more than the PAYE route. So they really have shut down the dividend route for people who've got service companies or people like myself who own a business. It's actually better to pay ourselves PAYE than it is to take dividends, which is a pretty crazy thing to get to. Unfortunately, we had no solution for that other than living like a monk for 2 years, to 3 years to try and get to the next election. But it doesn't feel particularly attractive to live like a monk for 3 years. Right. Harry, you're going to talk to us about savings and property.
Perfect. Well, thanks very much, and hi everyone. Because of course it's not just dividends rates that have gone up. We've also seen income rates on interest and other savings income go up, so by 2% across all the bands.
So
So
these are 10% tax rate. If it's 2% on the basic rate, it's 10% increase in tax.
exactly. So from savings income for a basic rate taxpayer, they would have been paying 20%. Now they're paying 22%, a higher rate from 40 to 42%, and an additional rate again from 45 to 47%. So we've seen the rates go up, but we've also seen, that fiscal drag relating to the personal savings allowance as well. So this is something, fiscal drag is a term that I think people haven't really heard about much a few years ago. It's mentioned all the time. We've seen it with income tax rates. We've also got it with the personal savings allowance, which has been frozen at its current rates since the year 2016. So a basic rate taxpayer can earn £1,000 of interest. A higher rate taxpayer can earn £500 of interest. An additional rate taxpayer cannot earn any interest tax-free before they start to pay these rates. And as well as interest, of course, there's now a separate tax rate for property income. So again, it's all increased by 2% across the board there, meaning that any income via property falls within that. Not only is it unincorporated landlords, so it's landlords that hold property directly, but actually also UK REIT property income distribution as well. So that would also fall under this net. Now our core portfolios, we don't hold any REITs directly, but no doubt that is an area that individuals will feel that maybe didn't consider themselves landlords, but are certainly
Yeah,
falling within
it's
the
going to make
remit.
owning a property REIT directly pretty tax inefficient in terms of the income coming in.
Absolutely.
So all these things are basically pushing tax up. So we've got a Labour government, we should expect it. But basically, it's quite stealthy, I think it's fair to say. Would you both agree with that?
I agree, yeah.
They're not, they've kept to their promise of not putting the rates up, but by increasing the amounts on certain things that they feel they can get away with and keeping these thresholds wound in tight, we're effectively all getting a 10 to 15% tax hike, depending on where we sit in the food chain. Then we've got some new taxes. Mihir, quickly, the mansion tax.
Yeah,
Perhaps
so
not as bad as people thought, but run us through it.
yeah, no, absolutely. I mean, this was rumored in the press as
Well
well,
telegraphed,
well
wasn't it? Yeah.
telegraphed, and it's finally here. And really, it impacts properties above 2 million. And there's various thresholds. I'll quickly go through them. So bear in mind, this is on top of existing council tax. So this is what the property owner will be liable to pay every year, if your property value is between these thresholds. So for values between 2 to 2.5 million, it's another £2,500 per annum. For between 2.5 to 3.5, it's £3,500 per annum. Between 3.5 to 5 million, it's an extra £5,000 per annum. And if your property value is over £5 million, then you can expect to pay another £7,500 per annum.
And we were just debating before we came live on air. There's a bit of difference here. So the council, Harry, you were saying the council tax is due by the tenant if you're in a rented situation, but this new tax will be due to the property owner.
Absolutely, the owner.
But it's going to be collected in the same tax demand effectively through the council tax, do you think?
Well,
They haven't been clear on that.
it's more of a wealth tax in some senses, because rather than the person living in the property, it's ultimately a levy on the owner of the property.
Yeah. So I think we were discussing this morning as we were preparing. We all thought this was a toe in the door, a foot on the threshold. They're wiping their feet on our mats, just getting ready to come in and probably tax more on property values as time goes by. It doesn't feel particularly bad, this one, but it's putting the mechanisms in place and creating the precedents basically to taxes on property assets going forwards, which is pretty scary, but there we go. Mansion tax. Now we come on to a few taxes that some of them were telegraphed, and some of them we think are a little bit strange, and we're not too sure whether that really mean that they're actually going to do it, or whether they were just fiddling around with the tax rate so that she could get her budget projections correct for the Office of Budget Responsibilities. So, Harry, quickly, the salary sacrifice. I think we know, well, we don't really know how it applies, but just give us a bit on that.
Yeah, I think this is a very interesting one for a number of reasons. So, at a headline, the amount of pension contribution that you can put into a pension via the salary sacrifice mechanism is £2,000 per year. And anything over and above that you salary sacrifice into a pension will now be subject to employee and employer national insurance contributions. Now, it's only salary sacrifice, so employer contributions, doesn't matter how large they are, they're fine. So for company owners.
So you and I had different interpretations of that before we sat down. So that's quite interesting. That employer contributions in their cells is fine. It's only when you sacrifice salary to make an employer contribution that they're looking to tax it.
Absolutely.
But
so
also,
if you got a bonus and you sacrifice that bonus into your pension, that would fall under this net. If you're just getting a large employer pension contribution,
employer contributions would be fine.
Yep. Absolutely.
Employee contributions would be fine. So actually, we began to start thinking, how are they going to police this? How's it all going to work? And then, not surprise, it doesn't come in until
2029. But what's really interesting on the figures, on the headline figures, it's actually the second largest revenue raiser after the freeze in income tax. So it's looking to raise 4.7 billion projected to from when it comes in its first year, which, as we know, is of course April 2029. And what's interesting about 2029 is that's going to be the election year. That's the latest, the election year. So are things going to change between now and then?
This looked like a really sort of I don't know how would you describe it? A political move to create something that made the forecast look good, try and convince the bond markets that everything's hunky-dory, with a tax which we think looks really hard to collect and wouldn't be that difficult probably to circumvent in any event. And so, we're a little bit dubious about that whole tax, really. Mihir, you were going to talk about ISAs because this is where we have got a change.
Yes.
But not in the main ISAs.
No, not in the main ISAs. And to be honest, it's probably, not as bad as people were fearing given the headline. So the headline here is that for cash ISAs, the limit is now going to be £12,000 for under 65. So if you're over 65, you can continue on as normal. If you're under 65, you're limited to £12,000 in your cash ISAs. And the interesting thing that has come out in the last few days post the budget is that there's been no sort of definite confirmation from HMRC or the government, but there's various reputable sources saying that they are looking at ways of restricting the legal loopholes that people may use to circumvent these measures. A couple of them being, for example, holding cash or cash equivalents in a stocks and shares ISA. Although how you define cash equivalent, it remains to be seen, and particularly for us because we have our B1 portfolio,
Yeah.
which is cash or cash-like in
Yeah.
short-dated fixed interest. So we'll be monitoring that area
So
keenly.
we'll make sure that our lowest risk bond portfolio is effectively ISA eligible in a stocks and shares ISA, not a cash. It won't be deemed as a cash ISA, and we would highly recommend clients if they want liquidity inside their ISAs, then you hold our B1 portfolio and it should be fine, and we'll adjust it in order to be on the right side of the rules.
Yeah.
I've never really understood why people wanted to have cash ISAs, so I don't think we've ever recommended people put money into cash ISAs. Mostly what we do is scoop money up from cash ISAs, and if you scoop from a cash ISA into a stocks and shares ISA, you can't go back.
Yeah, no, they're looking to restrict that as well.
But that doesn't really bother me too much. So, cool. So we've covered cash ISAs. It's worth saying we're not going to cover everything because there were things on EOTs and various taxes which we feel are probably too deep, and we'd be here all evening if we tried to go through them. We're going to just try and pick on the main ones. And Harry, you wanted to say something a little bit about inheritance tax.
Yeah, I think inheritance tax is something that was big in the last budget, and again, it wasn't one of the core focuses, but yet again, we've seen another freeze of the rates. So, again, that fiscal drag.
And did you have a number for us? Because this one was set in 2009.
Yes. So the nil rate band, the £325,000 per person, has been the same now since 2009. So if we just increase that by inflation, we'd be over £500,000 per person already. So that's pretty significant.
So 750, no. Yeah, what have we got? 725?
No, 325 or 650 if you're a couple.
650, and it should be $1 million by now.
It should be. Now, of course, we do have the residential nil rate ban, that additional ban that was introduced in April 17, and it's at the same level now in 2020. That's an extra £175,000 per couple. So you do still have that theoretical million that people think about. But as usual, the devil's in the detail. Not everyone gets access to that additional residential nil rate ban. For a start, if your estate is over 2 million, your total estate, you start to lose some of that. If you're above 2.7 million, you've completely lost access to the residential nil rate ban. If you're not leaving a main property to a direct descendant, maybe you're leaving it to a niece, a nephew, or anyone else, again, you wouldn't have access to that. So the devil's certainly in the detail there. Of course, the elephant in the room is, of course, the pensions, the fact that this isn't this budget, this is last budget. Pensions currently outside the inheritance tax net.
Coming in.
They are coming in April 2027. So,
and we've discussed at some length, actions to take on that, but I'm sure we'll be doing more of that coming forwards.
Absolutely. So again, not a friendly budget for inheritance tax.
Perfect. So that's all the depressing stuff out the way. It's been up, taxes up, making it harder. But the good news is there was quite a lot left unchanged, which gives us still the ability to help take some of the pain. We don't have to go the monks route. We can actually help you all and try and get around some of these things. Mihir, what can we offer in the income tax zone?
Yeah, so in terms of mitigating income tax, thankfully, a lot of the mechanisms remained pretty much untouched in this particular budget, by and large. So, for example, there was a lot of fear amongst our client and the wider sort of country as well about the pension tax-free cash limits. That has not been changed. It still remains at 268, 275. If you're working, you can still use the carry forward facility from pensions, so you can use up any allowance that you haven't used in the last 3 tax
So we can
years.
still make 60,000 a year, and potentially we've got 3 of those to go
Yeah.
out at any one time.
Yeah. You can also obviously continue to get income tax relief on pensions, up to 45% if you're an additional rate taxpayer. So pensions, by and large,
And going back to your original case study of the £100,000, 100% marginal tax rate, that individual could help enormously by doing
absolute
a
no-brainer.
salary sacrifice pension, which we've still got open to us for another 3 years.
3.5 years.
So
3.5,
we're
yeah.
good to go on salary sacrifice pension contributions.
And on top of pensions, obviously the ISA limit stays the same.
Yeah.
The stocks and shares one anyway.
There was fears that there might be some cap on the amounts of we could have in ISAs. Now
Correct.
that happened.
And offshore bonds have remained untouched in another budget. Which
So
was
that's just to be clear, that's the tax on single premium life insurance policies, which has been exactly the same treatment for my entire career, hasn't changed. Nobody seems to want to change it. I don't quite know why, but nobody ever challenges it. And that is what our offshore bond products hang off, which make them very tax efficient.
Yeah. So all in all, a lot of financial planning opportunity there, particularly to shield you from the worst effects of income tax. Yeah, I'll hand over to James to discuss capital.
Yeah, so the big thing is that capital gains tax still remain substantially lower than income tax. We don't have any of the national insurance issues or any of that stuff. And we're paying basically 18% as basic rate taxpayers and 24% as higher rate taxpayers when it comes to capital gains tax on the sort of things that we're going to invest you in. Obviously, if you're investing in property, the tax rates are a bit higher. Do you know those numbers off the top of your head?
No, so they've essentially bought them.
It's equalised now.
It's equalised.
24.
Yeah.
It's 24. Okay, so there's no premium now for property.
No.
There you go. You learn something all the time. So we've got 18% and 24%, which now compare very favourably to the higher rates of income tax. There is really a minimal CGT allowance each year. It's £3,000. So basically, you're straight into those rates. But certainly for investing in gilts, which are tax-free anyway for the capital gain, but also investing into the equity markets, which are not paying big dividends, capital gains is still a very nice way to get taxed, not least because you don't pay it each and every year. You only pay it when you crystallize the gain. So in effect, you've got tax-free roll up until you want to cash something in. So you're not having to pay it year on year, which you do with your income tax. So I think capital gains remains quite a big area. Harry, inheritance tax planning. This is something which I suspect these guys are going to be doing most of their career, because over the next 10 or 15 years, it's going to become a really massive area for financial advisors. So what are you thinking, Harry?
Well, absolutely. I mean, year on year, I think I've spoke more and more about inheritance tax than I had the previous year because of all these changes. It's things that people are thinking about more, and why there is certainly some doom and gloom. If you listen to my first monologue, I think absolutely there are some really good planning opportunities that are still available to all of us. So yes, they've frozen allowances. However, potentially exempt transfers, for example, so gifting money, they haven't put any caps on that. The number of gifts that you can make or the amount that you make on those gifts, as long as you live 7 years after that, that is still available to anyone. Another sort of rule that is maybe slightly less known is that gift out of regular income. So the ability, if you can demonstrate you've got surplus income and you're gifting it on a regular basis, then it's immediately outside of your estate. So something that's actually really powerful, and it's something we're having more and more conversations with our clients about, particularly out of their pensions.
Yes.
Now, I think for pensions it used to be just keep the money in the pension,
Yeah,
because it's free from inheritance tax. Obviously, the planning around that is completely changed now.
the pensions have gone from the bottom of the stack up to the top of the stack. So instead of keeping them forever and passing them on, we're now going to basically, try and cash them through in our lifetimes. But what you're saying, Harry, is there's no point in cashing them in and holding on to the money.
Yeah.
You either want to spend it, so you're spending your pension fund over time, or you want to take it out, pay the tax, and then gift it to make sure it's out of your estate and doesn't get taxed twice.
Absolutely. So even paying a bit of tax on it now and
Yeah.
gifting it away can often be much better than the alternative.
And we've got
Now,
these horrible tax rates
I've
if
got a
you
bit
don't
of,
get it right.
in fact, I've got a bit of a technical example here that
Okay,
I want to
try
walk
it.
through.
Right, Harry, let's try it.
So hopefully it's fairly easy to follow. So the example is we've got a couple who have got a £2 million estate excluding their pension. So that 2 million is their property, their ISA, their savings, their cars and jewelry, and they've got a pension as well, £700,000. So total they've got 2.7. So as of today, you exclude the pension.
Yep.
They've got a £1 million, a £2 million estate rather. The first million's exempt from inheritance tax.
Yep.
The second million is taxed at 40%. So nice and straightforward, they have a £400,000 inheritance tax liability. Same couple, same situation. Let's fast forward to after April 2027. This new couple now have a taxable estate of 2.7.
Yeah.
The pension that are out have now been dragged in. But it's an additional negative situation because now they've lost the residential nil rate band.
So this couple now are the income tax equivalent of our poor chap who's only 110,000. These guys are now going to get absolutely slaughtered for inheritance tax if they haven't done it properly.
Absolutely. So they no longer have the residential nil rate band.
So they're losing allowances.
They're losing allowances. Their pension's now being taxed. So rather than having a £400,000 inheritance tax, they've now got an £820,000 inheritance tax.
So although the estate has only gone up 700,000, the tax bill has doubled.
Absolutely, absolutely. And it's even worse if their kids are additional rate taxpayers. Whatever's left of the pension then could be taxed at 40, 45%, maybe even over 100% if we use Mihir's example earlier. So, really careful planning can have massive impacts when we're thinking about how to structurally draw pensions and how to.
I mean, it's fair to say that we still, with inheritance tax, it's still largely a discretionary tax in so much as you can go to the grave if you're reasonably careful and organised with £1 million estate and pay no tax. But it takes quite a lot of, and it's going to take increasingly more organisation to do that. I mean, historically it has been relatively straightforward to do that. My father-in-law and mother-in-law passed earlier in the year, and we look like we're probably just about going to get scraped through. We might get caught for 30, 40,000 somewhere along the line. But that is probably the end of that generation who are in their 90s now. Those are going to be the end of the generation who are going to be able to squeak through without much tax. Increasingly, people are going to get caught, and if they don't get the planning right, they're going to get whacked pretty heavily.
I think it's important that it's planning over time.
Yeah.
There's rarely a silver bullet.
Yeah, it needs to be thought through, and we need to be looking at it 20 years out.
Absolutely.
Basically. Cool, fantastic. So just to summarize on all of this, we've got tax rates going up for income tax. There's limited amounts we can do to help employees. Obviously, we can help them with the pension contributions. There's some other things like VCTs where we get some allowances, but they've nibbled away at those as well to try and reduce them a bit. But basically, employers and employees are going to have to work hard to try and reduce tax along the way, and there's not too much they can do. But for our clients who've got capital and who are looking to earn a return from their savings capital, we're still in a pretty good position. We've got pensions pretty much unchanged. We've got ISAs pretty much unchanged. We've got our GIA accounts. We can still hold gilts and pay no tax. We can still hold equity funds, growth equity funds, and pay capital gains tax rates. And, you're going to have to work quite hard in retirement to have a tax rate over 40%, I would think. Most of our clients are probably paying somewhere around 27, 30% tax. If you're very lucky and very wealthy in retirement, you might make 40% tax. It really is the young employees who are going to get hit the most. Actually cracking through this reasonably quickly, aren't we? And have we had any questions at this point? Please ask us some questions because we have some more to cover, but we're going to need some live Q&A would be great. So if anybody's got questions on anything that we've raised so far, that would be brilliant. We thought we would do a poll now. So there's been a lot of talk about leaving the country. And actually, in the last month, we actually got a YouGov poll done, which I won't tell you the results of. But we just asked you to say, there you go, would you consider leaving the country, yes or no, or in the next 5 years? That's quite interesting. So we have got a result there where 36% of our audience are saying they might consider leaving the country in the next 5 years, which is quite a scary rate. Our YouGov poll actually came out with a figure of 11%. It was done nationwide, and it actually focused, it was basically saying that the people most likely to come out were the young high earners, as we've discussed, who are caught by this fiscal creep and these higher rates. And we got some questions coming through now. That's good. What client is best suited to an offshore bond? Who'd like to tackle that? Mihir.
Yeah, I'm happy to take that. So an offshore bond, without trying to go into sort of too much detail, really gives you the opportunity to not only avoid having to pay income tax because it's an income tax deferred product. So you can take out whatever initial premium that you put in, 5% of that over the, maximum 5% over the next 20 years, and you can carry forward any cumulative allowance that you haven't used. So really, the best client suited to an offshore bond is those who have already maximized their ISAs. They aren't able to or have already maximized their pension contributions. And they really have excess capital that they then need to invest in a tax efficient manner, but which then still gives them the opportunity to gift it in the future to their chosen beneficiaries.
I would summarize it by saying you've got to have used your ISA allowances and done much of your pension planning first, and used your GIA for capital gains growth type stuff, or gilts if you want to have some liquidity. But beyond that, the offshore bond starts to make some sense, and it is it's a really nice way to own investments because you don't have to put anything on your tax return. It's extremely simple. And we've now got, I don't know, 20 or 30, I think, maybe more. And the demand for offshore bonds has gone through the roof with providers. So it is going to be something that I think a lot of people are going to want to consider who've maxed out on the ISAs, maxed out on the pensions. I've got two more questions coming in, both good questions. First one, is it possible to plan ahead for policies that might change in 3 years? So this is the live like a monk, defer all these things and hope for it to change. I mean, yes, there's definitely the pension one is an obvious. I mean, you could say, fine, I'm not going to strip my pension. I'm just going to let it build up and hope that this rule gets changed and draw it out, at later dates, hopefully at lower tax rates, and hopefully the inheritance tax issue will go away somehow. All I would say to this is that, and I'm going to answer this if that's okay.
That's fine.
All I would say is that these taxes are being created not for fun, but they are being created by a very tight fiscal situation that the UK is in, both in terms of the amount of debt it has. So we've got some numbers now about how much the interest on our debt is costing us, but it's
10%
of the tax receipts are going on interest.
Absolutely.
So roughly 10% of all the tax collected each year now is simply funding the debt. This is a bit like everybody else who's had a mortgage that was on the very low rates. It's now coming off the very low rates. It's being refinanced at much higher rates. And this situation is just going to get worse. And then you've got the budget deficit, which is up from year to year. How much is the government spending versus how much it's collecting on receipts? And clearly this government hasn't really grasped the nettle to try and restrain spending. In fact, it's done the opposite. It's increased spending and said we'll fix that by taxing pension contributions and salary sacrifice in 3 years' time, which may be a little bit optimistic. But I guess doing nothing runs the risk that this never goes away and just gets worse. Couple more we could do now for those.
We've got a good question there at the top relating to gift out of regular income.
Yeah.
So it talks about really
tax?
asking for a bit more information around that. And is there a tax liability on the recipient of that gift out of regular income? I mean, the short answer is no, there's not. Gift out of regular income, there are some caveats. It has to be demonstrated that you are gifting sort of out of surplus income. So, if you have £50,000 a year of income, you're spending £30,000, you can give the difference as a regular income. It can't be a case if you got 50,000 of income, but you're spending down on your capital, so you're gifting some of that income away. It has to absolutely be demonstrated that it is surplus income. However, pension drawdown counts as income. So
Yeah.
if we can demonstrate that what you're drawing from your pension is a sustainable withdrawal rate,
Yeah.
which you absolutely can, and you're recording that you're regularly making these gifts, there's no income tax at all on the recipient, and it is immediately outside of your estate, so you don't have to wait that 7-year clock.
Yeah.
So it's a really, really powerful tax planning tool.
So thank you, Harry. There's another question here. Could you comment, and this actually was several people emailed this question in before the webinar. Could you comment on the trust? And I've got a little comment on this before we do that, which was on a recent trip up north to see my relatives. One of my cousins said, "Oh, the bank suggested we set up a trust," and I sort of would suck my teeth a bit, and this was a couple who probably just about had £1 million worth of assets. But the advisor at the bank had said, "Oh, inheritance tax, blah blah blah. You need to set up a trust." What do we think about trusts, man?
Well, trust really only makes sense if you want to retain some sort of control
Yeah.
in the scenario where you're gifting. Because that's sort of the major pro. But compared to the pro, the cons are that you have to pay the administration costs, there's tax
in the
going
trust.
in, tax
Yeah.
going out, periodic taxation charges. You're much better off either gifting out of regular income, or just gifting a lump sum outright and then surviving 7 years and kind of foregoing the need to have trust in place.
I always refer to my taxation and trust handbook about what are the 3 reasons to set up a trust. They set them up in South America so you don't get your kids kidnapped. So for anonymity is one reason. Controlling a wastrel is the other, which is basically where you've got people who can't spend, you don't want to trust with the money. But basically, when you think about the money that you might put into the trust and what the next generation could do with it, with careful planning, so for example, putting into pensions themselves, putting into ISAs, all of these things are going to be much more tax efficient than having a trust. So I would think very carefully before setting up a trust for inheritance tax. There may be some situations where it makes sense. Sometimes if your kids are in other countries where gifts are taxed if they receive them. For example, we have one couple that fall foul of that, and so we've used a trust for them. But I would say it's a minority sport rather than a majority sport.
Yeah.
We'll do one more. Mihir, would you like to answer this question on the ISAs?
Yeah, it's a good question from one of the viewers. So will the change in ISA allowances only relate to new investments? So that it would be our understanding, yes. So if you already have money in cash ISAs and you don't transfer that outside of the cash ISA, then you should be able to maintain that cash ISA status. From our understanding, it looks like it's really new money that is going into ISAs that would be restricted by the 12,000 limit for under 65s. Or if you transfer to a stocks and shares ISA and then want to transfer it to a cash ISA at some point in the future, then all these various checks and balances that we described earlier, they may come into place. But as things stand, if your money's already in a cash ISA, then it should be fine and you shouldn't be restricted.
And we were talking about this again this morning. If you want a cash ISA, Tideway can do that for you. There's no limits on how much you can put in. The rate at the moment is about 3.7%. It's tax-free. So it doesn't matter what rate of tax you're paying, you won't pay any tax on it. And that's basically a gilt portfolio. So if you want a liquidity pool, which we all need for emergency purposes, and you're a higher rate taxpayer, perhaps because you're turning on your pension withdrawals, and you're beginning to spread out income to both in a couple or whatever, and so you're getting dragged into tax on savings, then just for holding liquidity, the gilt market currently offers a great opportunity to effectively create a cash ISA. So deposit rates, no tax, instant access, 7 days. So that's the solution to that. Right. Moving on. Yes, we thought we'd quickly look at the economic impact of the budget. We talked a little bit about this in the market update on Friday. I wrote about this. I'm going to cover the fixed income. Mihir's going to talk a little bit about equities, and then Harry's going to talk about property. So in terms of the fixed income, the big thing was that we had stability in the gilt market, which is good for us. So I think there were some questions on there about the level of fiscal headroom. I think that's all quite a bit of window dressing. I think the reason Rachel Reeves is getting a bit of a shellacking about whether she misled the country or not is the fact that things were actually getting a little bit better in terms of the budget deficit and the headrooms. So growth is a little bit stronger than was anticipated. And broadly speaking, the gilt market has been unmoved by the budget. It hasn't particularly rewarded the budget in terms of reducing yields, but it didn't punish the events by pushing yields up. So we have kept this fairly now stable yield curve with rates at the near end around 3 3/4, up to 5.5 on the long end for the gilt yields, and our corporate bond market sits above that by 2 or 3% and 4 or 5% when we go into the high yield market, and that's what's driving the return in our fixed income funds, and that's not changing. So that's all good news for us. Here on the equities, what have we got to say on that?
Yeah, so on the equities front, the key thing to understand is that UK equities, as part of a wider portfolio or an index, are pretty much almost inconsequential
Yeah.
now. Even the holdings that we already have, they're, for all intents and purposes, they have majority, if not all, of their operations globally. So even though they're listed on the London Stock Exchange, by and large, they are pretty much foreign companies.
So I think I wrote on Friday, we own 3 times the world index allocation to the UK, but that's still only 9 and a bit percent.
Yeah.
And as Mihir says, most of them are international businesses earning dollars, and so they're not really focused on the domestic economy. So
Yeah.
not much impact from equities.
Not much impact, no.
Property values.
Perfect. Yeah. So we had a lot of questions before
Yes.
the webinar talking around property and some of the changes that property have had over recent years. I think we've actually got a poll because
Oh yes, we
before
want to do that.
yeah, before I start, it'd be interesting to understand.
So we've got another poll here about property, and we're talking here about retail, residential property, resi, as we call it in the trade. Not that I'm an estate agent, but will UK property prices increase in real terms? So what we mean here is, will they go up by more than inflation in the next 5 years? And the answers are coming in thick and fast. And we thought we'd ask you this question before we gave our thoughts on this. So we've got roughly 60% thinking that they won't, and 40% thinking that they will.
Interesting.
Harry, what do you think?
Well, look, we don't have a crystal ball,
No.
obviously, but I think it is interesting because certainly there's more negative sentiment about UK property, particularly being a landlord.
Yeah.
Especially a small landlord who's holding properties in their personal name, they're renting
Yes.
out. Obviously, we've already talked about the additional 2% on property income. Obviously, the thresholds have frozen as well. The Renters' Right Act received royal assent in the UK and will become law early next year. So that's going to mean that for landlords, there's an increased risk of them having
So these are things like
no fault evictions, and areas like that. So it's certainly there is some negativity around that. In London, particularly, the property markets have struggled. So recent figures from the Office of National Statistics has shown that London property has fallen in the last year to September, not only in real terms but also in nominal terms, so actually falling around 2% over the last year. Obviously, we've got this extra council tax, the property surcharge as well, which there's speculation that that's going to hit the top end of the market and potentially cascade down. So there are a lot of sort of potential headwinds relating to being a landlord.
When I log on to my Tideway app, it tells me how much my house has gone down in Barnes, which is very depressing every time I open it. But it does appear that London property prices are in decline. I think what's happening there is we're shifting from a quite internationally buoyed market with the Russians and the Chinese buying to one now, which has got to be mostly domestic again. And the prices were so stretched, we've now got to get lawyers and professionals in the city their earnings up to the point where they can start buying houses in Notting Hill again. And there's a bit of a gap to catch up, I think, from where they got to with interest rates at rock bottom. Now we've got mortgage rates at sensible rates. So I probably think, I think that the prices will increase in nominal terms, probably because we've had a lot of inflation and earnings are rising reasonably rapidly. So I think that affordability gap is going to get closed. But I think probably I would agree with the poll there that in real terms, I'm not expecting great returns out of residential property. And probably some of the other areas of the country actually got a bit more frothy. So London's been falling for a while. So there's other areas. I heard anecdotally in the Golden Triangle of Cheshire, the footballers' houses were on their backs somewhat. So that's good.
I think we've got a few.
We got a few more questions we can answer. 10 more minutes left. So now is your opportunity to get your questions in. The headroom we've talked a little bit about. How would I best put money aside for my 3 young adult children to use to put down as a deposit to purchase a property for themselves, looking to pay out 3 different times? Now, guys, because I don't know anything about this, but what's happening with this buy to whatever ISA? Can you do the lifetime ISAs?
Yeah, so there's a consultation out. It looks like that nothing's concrete yet. There's a consultation for something to essentially replace the lifetime ISA. The lifetime ISA has some serious flaws in it, and that's something they're looking to do a consultation on, but nothing concrete apart from that we know.
I would suggest possibly in that scenario, you might want to consider having a gilt portfolio. If you're talking about a 3-year time horizon, you don't really want to be messing around with stocks and shares because the risk of there not being a return on your money over 3 years is quite high at the moment. So I would say, keep some money in gilts, and then as you've raised the fact that the timings might be different, you could pay out the gilts in different blocks. And obviously, when if you're going to give money to the next generation of adults, you need to look at their tax position to see what they're doing. Because if they're earning and paying high rates of tax, and you give them the money and they go and put it in a Chase account, they're going to just aggravate their tax problem and end up paying a load of tax on their interest. So it would be better just to hold gilts. Either they could hold them if you want to give them the money now, or you could hold them and give it to them when you do, but then you're going to get your 3 3/4, just under 4% tax free on that money, which is a nice discount, 12% discount over 3 years. When might it become beneficial to pay 40% tax on drawdown income to get the SIP balance down? Now, what do we think? This is quite interesting because I've been bashing on about this for a while. But my sense is that when you talk to the clients, people don't want to do it.
Yeah, I think, from personal experience, a lot of the clients that I've spoken to balk at the idea of paying 40% income tax. Rightfully so. It's a lot of tax to be paying on any withdrawals. But I would frame the calculation in this way. So, were you to pass away after April 2027, after age 75, presuming you have an estate over £1 million, and then the pension is fully in your estate for IHT purposes, you're looking at paying not just 40% inheritance tax on that pension, but your beneficiaries will most likely pay 40 or 45% income tax when they come to draw that down.
It's a disaster.
It's a disaster. Yeah, effectively, the tax rate is 64 to 67% upon death in those circumstances. So compared to that, 40% now, it's not ideal, but it seems like a much better deal than having to pay 64 to 67%.
In the wake of the budget, I was doing the tax things for our own purpose. Ursula and I had a big powwow on Saturday, as you do every once in a while, to look at what we're doing ourselves. And, we got to the point where we're kind of okay paying 40% tax. Kind of okay if we have to, paying 45% tax. I don't think we're going to live like monks to avoid 40 or 45% tax, but we really don't want to be paying 55, 60, 65%. So we're very fortunate that it's our generation on the whole are avoiding those really ugly tax rates, whereas these youngsters, to get them over £100,000 now is pushing water uphill. But I think as people, sitting on the pension assets, we've got to look ourselves long and hard and say, if we just keep rolling it up, it's lovely to see when you log on every morning and the account's gone up in value. We're all used to accumulating and sitting on it, but actually we're not doing the next generation any help whatsoever in doing that. So I think we should be taking the money out, paying the tax.
But I think this is an example where it's very, very circumstantial, because not everyone should be paying 40%.
Yes,
it's really on the examples where by not doing anything, you're guaranteeing yourself. And I think the way we would frame this on an individual basis, do we look to actually build a financial plan to estimate what is the long-term trajectory of your wealth? What are you trying to achieve?
Yes.
And this kind of question really has to be answered on a one-off basis.
I think that's absolutely right, Harry. I mean, you've got to consider people's health. You've got to consider, are they, is there a spouse? What the situation is? What's the kid's situation? Are there grandchildren? It is actually not that bad to leave pension assets, miss a generation, push them onto the grandchildren who probably aren't going to pay tax to withdraw them. So then you don't get the double tax effect. So there are little wriggles in there to have a look at. But as we're being prompted from the other side of the table, speak to your advisors is the answer there. I think that's a good call. You implied earlier cash ISA is not a great idea, presumably such the way to go. Does this view change when market crash is all in the media talk? Yeah, well, look, that's a really good one, and I might just wade in on that because it's quite a big bee in my bonnet. We can offer you a cash plus portfolio in a stocks and shares ISA, which will have almost the same liquidity. You can have your money back in 7 days, and it will pay you 5% now, pretty reliably, pretty low risk. You can almost forget about the equity market crash because it would sail through that. And so really, I do think that the stocks and shares ISA was always a bad job. The cash ISA was always a bad job. We've always been able to offer better than cash deposit rates in relatively secure liquid portfolios. So I would hope that the answer is between the gilts that we could hold directly and get that 3.7% tax free, which is equivalent to about 6, Harry, if you're a 40% taxpayer.
Yeah, 5.5,
5.5, 6. So better than Chase. I know we know how popular the Chase banks have been, and they are very nice and easy to do. But a lot of people are sitting. You're going to find by the time they've paid the tax on those interest payments that they're nowhere near as good as owning gilts or having a B1 portfolio in a stocks and shares ISA.
I think just to add to James' point quickly, I think the branding stocks and shares ISA doesn't do it any favors.
Yes, it doesn't have to be racy.
That implies an obligation to invest in stocks and shares, where there's no such obligation. Like James said, there's various different options in fixed income and other places where you can reliably get 5%, like James mentioned, without taking on too much risk. So yeah, that's it. The naming and the branding and the labeling
is not great.
Misunderstand people.
We've got a couple more questions to get us through to the end of the session. Many analysts still to be bullish on US equities in 2026. Do you share this view given the current and contrary talk of an AI bubble?
Your favorite topic?
There's an hour. Harry, Harry, what do you think about that?
Well,
get the youngsters' view for once.
No, it's an interesting one, and it's certainly been talked about more and more. Obviously, I wish I had a crystal ball to know where the equity market's going to go. I'd say bubble potentially is a word that doesn't quite fit the situation, in my opinion. A bubble, something like the 1999 bubble, is a different situation. These US firms, they're valued on enormous multiples, absolutely. But certainly they've got massive revenues as well. Now, whether the stock market has a sort of a risk profile that's a bit overzealous at the moment is a completely different question. But going back to what you were saying earlier, this is why many of our clients actually prefer to not take any equity risk at the moment. And a lot of our clients don't need to be taking equity
Yeah.
risk because of the return you can get in fixed income.
Yeah.
So I think that's really the important point there.
I think you've got to, well, Mihir, what would you like to comment on that before I
Yeah,
stick my 2 feet?
I agree with Harry. I think we don't have a crystal ball, so people have been forecasting the demise of US stocks for a long time
And it
now,
hasn't happened.
and it hasn't happened. What I would say though is that if you look at all the data coming out of the US in terms of employment, other statistics, etc., the AI capex boom is basically sustaining the economy. Employment is down in other areas. Obviously AI is impacting indirectly employment in a lot of sectors such as tech and software and things like that. So, that's just anecdotal points though. But the market can stay irrational a lot longer than
Yeah.
you can stay solvent, as Warren Buffett says.
Yeah, very good. Very good. They've got all these youngsters, they've got all the talk. Yeah, I mean my thing is it's a little bit of a you've got to be very careful with the stock market at the moment. I do think there's potential for a wobble. There's a lot of bubble stuff. I mentioned Bitcoin in the market update on Friday, and somebody must have read it, but Bitcoin is off today 7 or 8% and causing some issues. There's a lot of leverage out there with a lot of traders in the US. I think mostly young men of these kind of ages who love to pile into these things, who have no real reason, don't know why they're in there particularly, and so when the market turns, they hit the sell button, and that's why we get these very volatile situations
and a lot of leverage
and a lot of leverage, which is getting wiped out. The spend is definitely happening in AI. There's no question about that. There's the evidence is all there. We can see the numbers. I think they spent in 3 months, 3 other companies spent twice as much as we spent on the Channel Tunnel, not the Channel Tunnel, the HS2. Just like spent it in 3 months, and so yeah, I mean, it is happening. I think you just got to be, as Harry said, we've got very nice 7 or 8% returns in fixed income. So, don't be afraid of saying, I'd rather have that, please, without the volatility. If you're going to invest in equities, make sure you've got a long-term horizon and talk to the advisor so that you're not going to get caught out with your cash flows if you need the money, is my answer. And I think on that note, well, there's one more question. Have we got time to answer that? I can answer that question because we've got a question here about HMRC's evidence requirements on gifts out of income. So there is this form IH400, which you end up filling out because we've just done it for Ursula's mum. And basically, it's 3 years. They're looking for 3 years worth of evidence where you can demonstrate that the income was more than the expenditure of the individual, and therefore there's the ability to make a gift out of income. And assuming you can fill out those 3 tables and have some backup evidence to show that each line you've got some evidence. Who's going to check this stuff? I wonder. I don't suppose, for the majority of very few people are actually filling out these boxes at the moment, but I think as time goes by, more and more people will fill them out. I think you just got to make sure that with, whoever it is that you're looking after to do this, as we did, you've got some evidence to show what their income's been, what their expenses have been, and therefore the gap, which will evidence the gap. If it's coming out of a pension, it's great because obviously we've got the documentary evidence coming out of the SIP, so that's easy.
Easy.
Good. We're done. Thank you very much for attending. Lots of people still on the call, so we have obviously been not too dull. And we'll see you again shortly. Thank you very much. Bye-bye.